In today's lesson, we are going to look at another very important topic in accounting. It is called methods of depreciation. Methods of depreciation. It's always in my culture to make students understand that, every topic that is treated, is very, very important in any accounting related exams. Students are fond of writing off certain topics, say this one is not necessary, this one is not necessary. I want to tell you that the method that is used to calculate depreciation is very, very fundamental in any accounting related exams, because the examiner must always give you questions to find out how strong your strength in using the various methods of depreciation. So today our emphasis is going to be based on those methods that will be necessary in calculating depreciation. But before then, let's look at our lesson objective. Now, when you talk about lesson objective, we are looking at the focus of our discussion, what we guide our lesson, those things that we need to achieve at the end of our interaction. And they are: number one, we will identify the various methods used in calculating depreciation. Number two, we will describe the necessary methods of depreciation. Number four, we will state the various accounts involved in depreciation. And number five, we will answer related questions that relate to what we are discussing. And then there's what we call success criteria. How do we measure our success? At what point can we say that we have achieved our objective? Number one, when we've been able to identify the various methods used in calculating depreciation, when we've been able to describe the necessary methods of depreciation, state the account involved in depreciation, and answer related questions from the exam guide. Now, before we actually mentioned the various methods of depreciation, I want to say that students should not rush into getting familiar with the method. You have to get yourself equipped with the necessary knowledge of what depreciation is all about, what assets are, because these methods are going to be used in different ways. So I will recommend that if you are just watching this video, you are going to look out for our video on depreciation. You are going to appreciate the definition of depreciation. You're going to appreciate the causes of depreciation. You're going to appreciate reasons why we charge depreciation. And you're going to appreciate the factors or elements one need to consider when you want to compute depreciation. If you have that foundational knowledge, identifying with the method of depreciation will not be a serious task to you. It will just be a very easy something. So I recommend you go back to that video and get yourself equipped with the information therein. Now, let's look at what we call methods of depreciation. We have different methods of calculating depreciation. But for the sake of this lesson, we are just going to mention few. Number one, straight line method. Number two, diminishing or reducing balance method. Number three, annuity method. Number four, sinking fund method. Number five, retirement and replacement method. Number five, sum of the year digit method. Number six, depletion unit method. Number seven, insurance policy method. And number eight, revaluation method. All these methods are methods used to calculate depreciation. We still have some other method adopted by different organizations. What I will say is that students should not be too rigid with accounting information. Accounting is a dynamic discipline. Accounting changes over time and policies. There are policies that will come up today, accounting policies that will come up today that will adjust certain methods that have been in operation. So companies and businesses can decide based on their policy the method they are going to use in calculating depreciation. So, but for the sake of this lesson, we are going to pick out the method that WAEC, NECO, JAM, and some other accounting related exams will expect students to understand. We may not be able to explain the 8 methods listed there. We are going to pick out the methods that are very common with the exams that we are preparing for. And the first one is straight line method. Now, this method makes provision for equal amount to be charged as depreciation for each year of the useful life on an asset. Now, the depreciation is ascertained by dividing the cost of the asset less the residual value by the number of estimated life. I want to bring it home. You know, the beauty of teaching is not just the number of things that is actually mentioned, but the number of things that students can understand and play with. That is why we want to take time to break this down so that students can play with this even during exams. Now, what we mean by making provision for equal amount to be charged as depreciation for each year of the useful life on an asset, we are saying that when it is a straight line method, that the amount of depreciation that is charged does not change. What am I saying? If we have arrived at 20,000 as the depreciation of the asset, if the asset is expected to last for 10 years, that 20,000 is going to be used for the 20 years period of time the asset will last. There will be no alteration, there will be no change, there will be no compromise on that amount. 20,000 will be charged in year 1, 20,000 will be charged in year 2, 20,000 will be charged in year 3, all through the useful life of the asset. There's something very interesting about this. We always make use of the word useful life. Certain assets can be in an organization and they are useless. When an asset is not contributing economically, when there is no future economic benefit of an asset, such an asset is useless. So we are not even talking about the number of properties that you have. We are talking about properties that are of economic value. And this economic value must have a time bound. So when we say that equal amount will be charged as depreciation for each year of useful life, if there is a particular year where an asset is put out of use, that particular year, the asset is useless. That's what we are talking about. So, and then we said that to get that value, what you simply need to do, subtract the residual value from the cost and divide it by the number of years. Don't worry, as we make progress, all of this will be very easy to understand. Let's look at the second method. The second method is what we call the diminishing or reducing balance method. Diminishing or reducing balance method. By this method of depreciation, a fixed percentage is written off the diminishing balance of the asset yearly. The total depreciation is spread over the anticipated useful life of the asset by annual installment of diminishing amount. Hence, larger amount of depreciation is deemed to occur in the early years and smaller amount in the later years of the assets. You know, let me try to explain certain terminologies here. Number one, diminishing. When you say something is diminishing in value, you are saying that the something is reducing in value. A constant, consistent, and uninterrupted reduction in the value of an asset can be seen as a diminishing asset. If an asset is consistently reducing in value, that's consistency in the reduction of the value of an asset. We can call it a diminishing asset. So when we bringing it to the method of calculating depreciation, when you hear of diminishing, we are trying to say that the amount of depreciation that is charged at the beginning or the year 1 of the asset will continue to reduce. Unlike straight line method. In straight line method, if it is 20,000 that is charged at the beginning of the asset, maybe year 1 of the asset, by the time you get to year 2, it will still be 20,000. But in diminishing balance method, if it was 20,000 at the beginning, the year 2 might be 15,000, year 3 might be 10,000, year 4 might be 5,000. So that's constant reduction. That consistency in the reduction of the depreciation charge is what we call the diminishing balance of the asset. And we have said something very fundamental. We said larger amount of depreciation is deemed to occur in the early years and smaller amount in the later years of the asset. Of course, I feel this is very, very professional. Because when you just acquire or when you just procure an asset, the asset is still sound, still very healthy and strong. So the depreciation that is expected to charge at the beginning of the year should be higher. I usually leave this for my student to pass judgment. I will ask you, if you are employed as an accountant and you are asked between the straight line method and the diminishing balance method, which method will you want to adopt? Will you want to charge the same depreciation all through the useful life of the asset, or you will want to charge higher amount of depreciation at the beginning and then lesser amount at the end of the useful life of the asset? Some students will tell you, sir, I feel it is important to charge depreciation, equal amount of depreciation throughout the lifespan of the asset. Some other student will tell you, no, sir, I feel because the asset is very strong and healthy at the beginning of the year, larger amount of depreciation should be charged. I leave that for you to pass your judgment. But I want to tell you that you shouldn't forget that whenever you are using diminishing balance method and higher amount is charged at the beginning and then lesser amount is charged towards the ending of the useful life of the asset. The formula is very simple. The formula is simply you subtract 1 from the root, the end root of the cost of the asset over the residual value. By the time we look at this one after the other, you will appreciate the formula. The next method is what we call the revaluation method. Revaluation method. Now, by this method of depreciation, the asset is revalued each year. Any difference will be charged as depreciation. It is good for assets like loose tools, hammers, chisels, spiners, livestock, etc. The value of the asset at the beginning and end of the year must be known. Like I said before, I will always want to bring it down for students to understand the method. Now, let me point out something. We said that the asset is revalued each year. Any difference will be charged as depreciation. The question is, sir, how do we revalue an asset? What do you call the revaluation of an asset? The revaluation of an asset is simply comparing the current value of an asset or the market cost of an asset with the current value of the asset. What do I mean? Now, last year, we bought maybe a Toyota Camry. We bought Toyota Camry for 5 million last year. And then this year, we just realized that Toyota Camry is now 10 million. What do? We bought it 5 million last year, and this year now Toyota Camry is now 10 million. Now, if Toyota Camry is 10 million this year, the value of that Toyota Camry that you have now, if you want to sell, first of all, when you secure an item and you want to sell that item back, you may not be able to sell it at the exact value with which you bought the item. You must sell it at a lesser value. So if the value of an asset now, the value of Toyota Camry is 10 million, you bought it 5 million, now it's 10 million. If you want to sell it, if you sell it at 3 million, you are not smart. Because anybody that sees a fairly used Toyota Camry at 7 million or 6 million or 8 million will rush it. Meanwhile, that 7 million at which you want to sell the Toyota Camry is even higher than the amount with which you bought the Toyota Camry last year. So at that point, that is what we call revaluation surplus. At that point, if you want to revalue your asset, you are going to revalue the asset based on the market value or the market price of the assets. So when you are doing that, we have what we call revaluation surplus and revaluation deficit. When the value at which you can sell the item is higher than the cost. Is revaluation what? Revaluation surplus. When it is less, it's revaluation what? Deficit. So now we said it is good for assets like loose tools, hammers, chisel. These assets are assets that ordinarily, when you have them in the organization, they are just there. They are assets that can last for a very long time. So what you do, you keep your constant revaluation is what will determine their depreciation. I remember some times ago, you want to buy this stabilizer. Stabilizer was an item that used to be very cheap before. You know, you bought one, maybe you bought many, I assume you bought stabilizer 3,000, and then you want to sell it. Maybe if no, let's not use stabilizer. Let's use land. I think land is an asset that usually appreciates. If you buy land now, 5,000, 5 million for a plot, you can be very sure that in 20 years to come, you will not be able to buy it at 10,000. It must be higher than 10,000. So, you know, you see people that will procure land now, or they will secure land now and want to sell it later in life. You know, land also need to be what? Revalued. So by the time you revalue it, the difference between the old price and the current price will determine your depreciation. The next one is what we call the sum of the year digit method. The sum of the year digit method. Under the sum of the year digit method, a decreasing depreciation is computed by a simple mathematical procedure relating to the arithmetical progression. We said a decreasing depreciation is computed by a simple mathematical procedure leading to what? Arithmetical progression. Each year of an asset life should be represented by a digit, and then you add this digit and charge fractions of the asset cost to the years in reverse order. All of these are just very vague at this point. You may not be able to appreciate them, but by the time we look at them one after the other and begin to solve examples, you will appreciate them. But what we are trying to say here is that when you are using the sum of the year digit method, what we do is that we apply one mathematical tool. This is what we call that arithmetical progression, where they are arranged based on series of number 1, 2, 3, 4, and then in the process of arranging them, you allocate the useful life of the asset. You allocate it to each of the figures, and at the end of the day, you will have a fraction that will now determine the depreciation for the period under consideration. Now let's make progress. The next one is what we call amortization. Amortization means the provision for the consumption of an asset with legal life, such as leases, patent, and copyright. These assets have connection with time. Hence, it can be defined as a process by which the cost of such lease is reduced by charging it to the profit or loss account. Now, there is something very fundamental I want to mention before I explain this. I want us to understand that amortization is used to charge depreciation on intangible assets. Assets you cannot touch, assets that you cannot handle with your physical hand, assets that has to do with time, or they may be non-current, but they are not physical. They are assets that are intangible in nature. You only feel their existence in the organization. They are only on record, but you cannot see them physically. So when they depreciate, they depreciate after some time. When they depreciate, the depreciation that's set into an intangible asset is what we call amortization. So we said it is related to what we call patent and copyright. They are assets that has connection with time. I have explained before that when you talk about lease, we're talking about items that are under rentage. You rent your building, you rent your motor vehicle, rent your plant and machineries. You know, there are companies that their duty is to supply these items at certain amounts within a period. They specialize on selling or giving out these items as, as rental items. So when companies take it from them. After some time, maybe if the item is expected to last within the contract or within the period of maybe 2 or 3 years, after the end of the 2 or 3 years, that depreciation ceased to be under the control of the party who rented the item. So at that point, depreciation has actually set in. Now, let's make progress. The next one is depletion. Depletion can be defined as a provision for the consumption of assets that have wasting character. These assets are mines, quarries, oil wells, etc. The amount written off from such an asset to profit or loss account represent the depletion. The amount that is written off represent the depreciation. I have explained before that when we talk about depletion, we are talking about depreciation that is charged on assets that are given to us by nature. There are assets that are given to us by nature. Example, oil wells. Example, quarries. Example, mines. Example, gold. These are items, these are assets that we get them, by nature. So when you continue to extract them, basically when you extract, there may not be provision for replacement. Once you exhaust a particular oil well, the oil well has depleted. And I will always use an example that students can go home with. The example of having a fish pond. When you have a fish pond, you have catfish in your fish pond, for instance, and then you are selling catfish. As you continue to sell, you have 200 catfish in your fish pond. As you continue to sell without replacement, at some point, you are going to exhaust the number of catfish in your fish pond. So by the time you have exhausted the number of catfish in your fish pond, the fish pond will become useless. The fish pond may be there, but because there is no fish inside, it's going to be useless. At that point, you cannot say that your fish pond has depreciated. What you will say is that your fish pond has depleted. So depletion is explaining a period where the asset has been exhausted. That is why we call it wasting character. It has an ability to be exhausted. And then that part that has been exhausted or that has depleted will now be charged to the profit or loss account as the depreciation. Quickly, let's consider account involved in depreciation. When you are preparing depreciation, there are certain accounts that are involved. We said the following account will be prepared for the post of the provision for depreciation. Now, let's not forget that depreciation is a provision. What do I mean? Most times when we talk about depreciation, if you enter the organization, if you have a building, you may not see part of the building that is collapsing before you now say, okay, this building is now depreciating. In a layman's eye, until they see a part of a building that is dropping or that is cracking or that look dilapidated, they will not think that the building is depreciating. No matter how beautiful a building is looking, no matter how wonderful a building is patterned, you should understand as an accountant that after some time, that building needs to be renewed. You have to repaint the building. You have to change certain things about the building. So if certain amount of money is not reserved from your profit, at some point when you will need to do this on your building, you will not have the money to do it. So we call it provision for depreciation. Money that is set out of profit to be able to replace the asset and to be able to reduce the tax burden that the government expects you as a business to pay. So the accounts that are involved, we have just 4 accounts. Number 1, we have what we call the asset account. Number 2, the profit or loss account. Number 3, the provision for depreciation account. And number 4, the balance sheet. The asset account is simply an account that is open in the name of the asset. Like I told you from the beginning, depreciation is basically charged on what? Fixed asset. So asset is the foundation of asset is the focus of our depreciation. We don't charge depreciation on current asset or on liabilities. We only charge depreciation on assets. So there is need. Once you acquire an asset, there is need for you to open an account in the name of the asset. Is it plant and machineries? Is it features and fitting? Is it motor vehicle? Is it land or building? If it is land or building, you open an account in the name of the building. If it is furniture and fitting, open an account in the name of the furniture and fitting. And then, after you have opened the account, the amount of money that is involved will be debited with the description cash, and then the same amount will go to the ledger. And then the second one is profit or loss account. Of course, depreciation is always an expense. So depreciation as an expense will always reduce your profit. So it must be charged to the debit side of the profit or loss account to reduce your profit. That is it. So it will be charged to the debit side of their profit or loss account, and then it will be subtracted from the amount of from the value of the asset in their statement of financial position, which we call the balance sheet. And then the next account is provision for depreciation account. Now at this point, you need to ascertain the different levels of depreciation all through the useful life of the asset. Each year has certain amount of money that is expected to be charged on the asset. So the provision for depreciation account is a liability account. So the amount that is charged will be credited while you have your balance carried down on the debit side. By the time we begin to solve examples and look at problems related to this, you will appreciate the beauty of this topic. And then the last but not the least is your balance sheet. Your balance sheet, or you call it statement of financial position, is simply your asset and your liability. It's a statement, it's not an account, by the way. It is just a statement that shows you what you own and what you owe. That's the simplest way I define balance sheet. I say balance sheet is simply what you own and what you owe. What you owned, they are called assets. What you owe, they are called liabilities. So what you owned, they are assets, and they are divided into fixed asset and current asset. Why what you owe, they are liabilities, and they are divided into long-term liabilities and what? Short-term liabilities. So the reason you have to prepare this is because the value, the net book value of the asset must be accounted for in your balance sheet. If it is not accounted for, you have misinformed the company about the position of their financial, of their asset. Every company must have an idea of the properties at their disposal, whether properties that are, whether leasehold properties, or there are properties that are secured, that are, whether they are leasehold properties or they are properties that is owned by the organization. So their balance sheet will always give you that picture of the asset you have, the cost of the asset, the depreciation, and the net book value of the asset. So far we have looked at the methods involved in calculating depreciation. Very quickly, we want to go into our exam guide to see if we can attend to one or two questions that will further explain what we have done so far. Now, if you look at our exam guide, if you go to our exam guide, you will see, when you click on exam guide, you see what is showing on the screen. You see, you see the various subjects there. Our subject is what? Account, financial accounting. And then you see the year. By the time you click on the year, you see different years. You can choose a year of your interest depending on the particular year you are looking for. And then after you have done that, the topic of interest is what? Is the method of depreciation, or call it depreciation. Once you have gotten that, you just click on get started. All the questions will just pop up, and then you begin to look at them one after the other. Now let's look at the first question here. He said the reduction in the value of an intangible asset is dash. You know, this is the A, depletion, B, amortization, C, appreciation, and D, depreciation. It cannot be depletion. We have said that depletion is related to asset with wasted or wasting character. And we have said that when asset has that ability, that asset does not depreciate, but it depletes. And then the second one is amortization. I think amortization is the term that is related to intangible asset. It cannot be appreciation. Appreciation in accounting is simply when an asset increases in value, when a value is added to an asset instead of depreciation. And then depreciation is the reduction in the value of an asset. So the answer there is B. Let's look at the second one. Okay, this one is for calculation. We are coming. They said, which of the following is not a cause of depreciation? Depreciation can be caused by different reasons. Now, they said number 1, wear and tear. Number 2, inflation. Number 3, erosion and decay. Number 4, obsolescence. Now, in our previous video, we have explained causes of depreciation. And then we said that depreciation can be caused by wear and tear, which we call physical factors. It can also be caused by erosion and decay, which is also part of physical factors. And it can also be caused by obsolescence, which is caused by changes in what? Technology. When there is a change in technology, an existing asset become obsolete or become old to fit into the current trend in technology. So the answer here is B, inflation. Which of the following is not a cause? Inflation cannot cause an asset to do what? To depreciate. And then let's look at question. Let's look at question 7. Okay, want to look at questions that will really bring the message home. All right, they say depreciation. They say depreciation of asset is provided for in consideration of dash. Depreciation of asset is provided for in consideration of what? Dash. Why do we need to calculate depreciation? Depreciation of asset, why do we need to calculate it? It is provided for in consideration of what? What are we considering when we want to provide depreciation? What are you supposed to consider? First of all, they say A is loss by fire. It cannot be lost by fire. Wear and tear. It cannot be wear and tear, and it cannot be what? Loss in what? Transit. So the answer there is disposal. The answer here is what? C, disposal. You know, what do we call disposal of asset? Disposal of asset is simply the sales of an asset. So when why you are doing depreciation is because you know that this asset, sometime you may dispose it one day. There's no how an asset can last with you forever. You may dispose it. One of these things can set in, and then there will be need for you to dispose the asset. So when the asset is disposed, if you are not making provision for depreciation, you may not be able to get a new one, because sometimes an asset that has depreciated over for some time, you may not be able to sell it at the amount with which you bought the asset, or you may not be able to sell it at the market value of that asset. You may sell it less than the market value. So what will now help you to get another one is the depreciation, the accumulated depreciation over the years. So far, this is how far we can go. We have looked at the methods of depreciation. We have explained each of these methods of depreciation, and we have also identified the accounts that are involved in posting provision for depreciation. And then we have looked at few questions from our exam guide. I recommend strongly that students should take time to look at this and then make reference to our previous videos on this, on depreciation.